I've watched hundreds of professional services firms celebrate record revenue years. Big clients, strong growth, everyone's super excited. And 6 months later, they're scrambling to make payroll. Here's why growing revenue doesn't automatically mean growing profit, and what you should measure instead. I'm Mike Hiley, Chartered Accountant, which is the UK equivalent of a CPA, 30 years in professional services, including time at WPP and Kantar, and I've seen this pattern at every scale, from a 30-person agency to global operations. In the next 10 minutes or so, I'll show you 3 reasons revenue growth often destroys margins instead of improving them. I'll show you what profitable firms do to track differently. This is a pattern I see repeatedly. Let's start with why everyone focuses on revenue. It's an easy number to measure. It's publicly facing. It sounds impressive. It's a vanity metrics. We grew 40% year over year, and that gets attention. But here's the problem with revenue as your primary metric. Revenue is an accounting construct. Long gone are the days when revenue meant cash in the bank. It doesn't tell you when cash arrives. It doesn't tell you what it would cost to deliver, and a setting doesn't tell you whether you're making money or not. Let me give you an example. A firm grows its annual revenue from 10 million to 15 million. 50% growth, everyone celebrates, and the team gets big bonuses. But when you look at the margins, that's when you see the issue. Year 1, 20% margins. 20% of 10 million is 2 million in profit. In year 2, you have 8% margins. Well, that's 1.2 million in profit. So revenue has grown by 50%, but profit has dropped by 40%. In fact, that's 800,000 less profit from $5 million more revenue. How did that happen? Because revenue measures what you invoiced, and profit measures what you keep after paying for the work. And as I'm sure you all know, the cost to deliver is a big part of your P&L and can easily grow faster than the revenue you generate. There are 3 reasons revenue growth destroys margins, and let me talk you through each one. First, growth triggers increased overheads to outpace revenue. When you're growing, you hire people, you win new clients, you open new offices, and all of that sounds like success. But here's the reality. New hires take 3 to 6 months to become productive. And during that ramp-up period, not only are your new hires not charging, they're consuming your senior people's time for training and mentorship. Your best people are doing less billable work to bring in the new people up to speed. Then new clients are unpredictable. You don't know their patterns yet, and you don't know how they'll behave. So you overstaff to be safe. And that's bench cost. New infrastructure hits immediately. New tools, new office space, new systems. Research from the Business Development Bank of Canada did work on this. They call it the difference between growth and scale. Growth means adding resources at the same rate as revenue. And that's what most firms do. But scale means revenues growing faster than your resource base. And that's what profitable firms do. Might be a little bit more painful, but it's definitely more profitable. And here's the killer. You need more non-billable people to manage a larger organization. More HR, more accounting, more admin, and more coordination. Studies from the BDC and the Beaton Global show these coordination costs often rise exponentially. They call it overhead creep. So you've got 6 months where costs are high, productivity is lower, and revenue growth hasn't caught up yet. Your P&L shows growth, your cash flow shows stress, and your margins compress. Firms that scale profitably anticipate this. They plan for the investment period. They grow at steady, disciplined rates, not explosive growth that breaks what they built. The second margin killer is what I like to call the utilization lie. Most firms track utilization rigorously, hours logged as a percentage of available hours. They celebrate when utilization hits 85 or 90%. But that number is lying to you. Utilization measures the hours logged. It does not measure the hours you get paid for. Research from Deltek found that firms fail to align specific employee strengths with the right projects. This leads to what they call missed revenue opportunities and preventable write-offs. In plain English, your people are logging hours, but they're not getting paid for all of them. Let me give you an example. A senior consultant bills them $300 an hour. They log 40 hours to a client project, and utilization looks great. But the client only agreed to pay for a junior at $150 an hour. So that work should have been staffed by a junior. You've just given away $6,000 in margin. Or a project goes sideways. The team spends 20 hours fixing mistakes. They log those 20 hours to billable time to keep utilization high. The client doesn't pay for the rework, and your margin collapses. A 2025 report from Dayshape and the Resource Management Institute found that only 26% of firms align their resource practices with financial planning. That disconnect means that even when revenue grows, firms suffer from what they call revenue leakage because they can't see how resource allocation impacts the bottom line. The profitable firms, well, they don't worship utilization. They track realization, the gap between hours logged and the hours paid. If you log 40 hours and you get paid for 30, your realization is 75%, and that 25% gap is a big chunk of where your profit went. The firms that scale profitably, they don't tolerate that revenue leakage. They track it, they measure it, and they fix it. The firms that struggle, they celebrate revenue and wonder where all the money went. Margin killer number 3 is what I call the complexity tax. This is the one that most firms never see. When you hired 20 people, coordination was simple. Everyone knew what everyone else was doing, and communication was easy. At 50 people, that breaks. 100 people, it's chaos. Here's what happens. More people means more coordination overhead, more meetings, more internal communication, and more context switching. Your senior people used to spend 80% of their time on billable work. Now they're spending 50% of their time on client work and 50% on management, coordination, and oversight. It's not a criticism. It's necessary. You can't run a 100-person firm in the same way that you run a 20-person firm. But here's the margin impact. Your senior people cost the same, but their billable output just dropped by nearly a half. And that means the cost per billable hour of your senior people has nearly doubled. If you don't adjust your pricing to account for that, your margin collapses. And then there's scope creep. When you're growing fast, things get messy. Clients will push boundaries. Your team absorbs it to keep everyone happy. The client asks for one small thing. The team says yes because they don't want to seem difficult. That small thing turns into 10 unbillable hours. Multiply that across 10 projects or 10 times, and that's 100 billable hours of free work per month. Research from SBR Consulting identifies what they call low-margin, high-support clients. Clients that drive up revenue but consume disproportionate resources. They're buying revenue at the expense of profit. The number of times I've been in the office or in an office at 8 p.m. and people are still working, trying to deliver to a client brief, well, that just beggars belief. And then there's the client acquisition cost. Scaling revenue requires more aggressive marketing and sales, more digital advertising, more lead generation, and more sales commission. If the cost to acquire a new client increases, it can offset the profits from the new work. This stuff doesn't show up in revenue reports. Your revenue line looks great. You hit your growth target, your team is busy, and utilization is high. But underneath, profit is bleeding out through 100 small leaks you can't see. Recent data from the Big Four and Accenture, the Big Four being Deloitte, PwC, EY, and KPMG, highlighted what they call the great decoupling. Traditional professional services relied on the pyramid model, where more people equaled more revenue. But firms that continue to grow revenue by simply adding headcount face stagnant profits because employment costs scale at the same rate as income. So, what do profitable firms do differently? They don't stop tracking revenue, but they don't worship it either. Here's what they also measure. First, margin by client, by project, by service type. Not aggregate margin, specific margin. Which clients are profitable? Which projects made money? Which services generate the best returns? This lets you make smart decisions. You can double down on profitable work. You can fix or exit unprofitable work. You can price accurately because you know what your true cost is. Second, realization, not just utilization. As I said before, utilization is hours logged. Realization is hours you get paid for. If your team logs 40 hours on a project and the client pays only 30, your realization is 75%. And that's 25% where your profit went. Most firms don't track this. They celebrate high utilization while realization collapses. Third is capacity allocation, not just headcount. Where is the effort going? Who's doing what level of work? Where is the senior capacity being consumed? Which clients and projects are using the most effort? And are those the most profitable ones? This is capacity management. It's not, are people busy? It's, are people busy doing the right things? Profitable firms are ruthless about this. They run at 75 to 80% utilization. They make twice the margin because they're selective about what work they accept. Here's the uncomfortable truth. These disciplines are hard. Not technically hard, emotionally hard. I know this from my own experience of running a professional services business. Tracking profitability means you have to face with clients that are destroying margins. That's uncomfortable when they're nice people or big names. Tracking realization means you have to see how much work you're giving away for free, and that's painful. Managing capacity properly means saying no to work that doesn't fit, and that feels risky when you're worried about revenue. So most firms don't do it. They celebrate revenue, they chase growth, and they hope margin will follow. But it doesn't. The firms that scale profitably make a different choice. They fix visibility first. They understand their economics. Then they grow deliberately from the position of clarity. That's the difference between revenue and profitable growth. If you're watching this and thinking, we just celebrated our best revenue year, but margins are flat or down, you're not alone. This is common in professional services, especially ones of your size. The good news is it's fixable. You can't fix what you can't see. And that's why we built the Profit and Capacity Diagnostic. It's designed to answer the questions that revenue reports don't. Which clients and projects are making or losing money? Where's your capacity being consumed and wasted? What changes will have the biggest impact on margin? The first step is the 20-minute assessment, where we talk through your specific situation. No pitch, no pressure, just a working conversation about whether you have the visibility you need to make the good decisions. There's links in the description if you're interested. And if this was useful, share it with another firm owner who's stuck celebrating revenue while margins stay flat. Thanks for watching, and I'll see you next week.